This accounting mini lecture covers adjusting entries related to depreciation. First, let's talk for just a moment about what depreciation represents. First, I want to emphasize that in accounting, the word depreciation has a different meaning than what you may be accustomed to outside of accounting. In accounting, the term depreciation does not indicate a decrease in value for a particular asset. Instead, depreciation is simply the process of allocating the cost of a fixed asset across its useful life. So again, this goes back to the accrual basis of accounting. We want to match our expenses against the revenues they help to generate. Therefore, we record depreciation expense in order to spread the cost of an asset across the periods for which that asset is going to be used to generate revenues. Now, let's look at our basic formula for computing straight line depreciation expense. And at this point, we're just going to focus on straight line depreciation. We will take the cost of the asset minus the salvage value, also sometimes called residual value. This will have to be given to you. This is basically management's estimate of what the asset is going to be worth at the end of its useful life. Okay? So we take the asset cost minus that salvage value and divide by the useful life, which may be given in months or years. Okay, let's look at an example. On December 1st, 2013, Fast Forward purchased equipment for $26,000 cash. The equipment has an estimated useful life of 4 years, that's 48 months, and Fast Forward expects to sell the equipment at the end of its life for $8,000 cash. That $8,000 would represent the salvage value. So let's determine the depreciation expense that we'll need to record each month. We'll take the cost of the asset, which is $26,000, minus the $8,000 salvage value, divide that by the 48 months, that's the useful life, and we get $375 per month. So basically what's going to happen when the company purchases the equipment, they are going to debit equipment for $26,000, credit cash for $26,000. We will then need to spread the cost of that asset across the 48 months that we're going to use the asset by recording this systematic depreciation of $375 per month. Now, let's look at what our entry is going to look like. At the end of each month, we're going to debit depreciation expense equipment $375, and we're going to credit accumulated depreciation equipment $375. Now, of course, depreciation expense is an expense account. It will be listed on the income statement as an expense, but let's talk for a moment about accumulated depreciation and what type of account that is. Accumulated depreciation is an example of a contra account, okay? A contra account is simply an account that will always accompany another account, and it will normally carry the opposite balance. Okay, accumulated depreciation will carry a credit balance. It will accompany equipment on the balance sheet. So we'll have equipment with a debit balance and accumulated depreciation on equipment with a credit balance in the asset section of the balance sheet. Okay. And here is an example of a partial balance sheet. We can see how that accumulated depreciation follows the equipment. And on the balance sheet, we would report the equipment at that net carrying value of $25,625, which is simply the cost of $26,000 less the accumulated depreciation. Thank you for watching this video on depreciation.